Welcome to this recording on advanced financial reporting. Today I'd like to look at group reorganization. From time to time, parent and its subsidiary may agree to reorganize, and so this has to be taken into account, or we need to consider how the individual financial statements of parent and its subsidiaries would change as a result of what we might call group reorganization. So at your own time, I would like you to read the introductory notes uh, in the record. Again, we're still using notes from London School of Business and Finance. There's a specific observation that is made in the notes that goes like, this is a very rare topic to be examined in your syllabus, and so let us just get an appreciation of this where you can see how far we can go. Before us is the question desperate. Allow me to go to the requirement. Set out the requirements in IS 27 separate financial statements as regards the payments of dividend from a subsidiary to a parent and as regards group reorganization, and apply those requirements to the individual entities in the disparate group. Excuse me. The next thing that we need to do is to prepare the individual entity statements of financial position for all the three entities as they would appear after the execution of the plan. Then B says discuss the key implications of the plan on the group. All right, so allow me to work through part A of the question, 1 and 2, and I would leave the comment for you to attempt. All right, so let us go to the heart of the matter. We have got the following scenario. Desperate Public Limited Company owns all the shares of Meat Limited and Need Limited. The group operates in Moon Freights, which is currently a depressed market. Needy has made losses and is short of cash. In order to address the problem, group directors proposed the following plan. And so as I go through these plans, I will be turning to journal entries so that we can understand what we are to do in the individual financial statements of the group members. All right, the individual financial statements of the three companies involved. So in the first note, we are told Meaty will purchase the whole of Needy share capital for 160 in cash. When Desperate receives the cash, Desperate will then lend that cash to Needy as a long-term loan. All right, so let us do some journals there based on that statement. So I'm in the books of Meaty. Meaty purchase, not purchases, but purchase. What will happen when Meaty buys the shares in Needy? So there'll be an investment asset, right? A financial asset. Investment in Needy, all right, reflecting in the books of Meaty. All right, how much would that be? 160 million, of course. Then there will also be a loss in money, because when you buy shares in an entity, of course, you have to reduce the value of another asset or indeed increase the liability. Let's go to the books of Desperate. So the payment is being made to the parent company. Okay, Desperate sale or indeed receipt. When Desperate sells those shares in Needy, what will happen? Yeah, of course, the money for the parent company will increase. That is a 150, and then we have to reverse the investment in Needy. So we credit investment in Needy, okay, which was recognized, of course, at 150. Now, I would like us to go back to the question at this point so that we see what is going on. Notice that the value of these shares which were purchased at 160 in the books of Desperate is 150 million. And so it seems to me that the parent company is making a profit. I think you know what is going on here. A profit of how much? The difference, of course, will be a 10. I hope that we can all see that. All right. Now let us progress. We are told that once parent receives the money, if I may go back to note 1, Desperate will lend that cash to the needy entity, the entity that is under serious trouble because it has been making losses. So we go back. Desperate loan. Desperate gives a loan to Needy. How do we proceed with the double entry? You debit Needy, all right, as a receivable. Okay. With that much, and then you credit bank. So this money is again leaving parent, going to the other subsidiary that is in trouble. All right, so that's what we have there. Okay, when let me just create some space here before I go to that other transaction too, or I might just drop it, hoping that I may have some space here. Let me just drop that. When Needy receives that money, we call that a cash injection. What will happen? Let me just write that properly. This is the book. We're in the books of Needy right now. So we debit bank, all right, with 160, and then we credit. I think you know what is going on. We credit a payable. Okay, or indeed loan from parent. I hope that you can see that. Okay, so we done with the journals. Now we proceed. We done with transaction 1 journals. Now we can proceed. We might as well proceed to transaction 2. And in transaction 2, we want to read again. Meet will purchase land from Needy and pay by assuming a loan from Needy and issuing non-voting equity shares. The land has a fair value of 20 million and an exit carrying value of 12 million. All right. The loan has a book value of 7 million. The issued non-voting shares have a nominal value of 5 million. So let us go to the books of Mitty and see how this transaction affects Okay, so again, it's a meaty purchase. Okay, so they get the land, so you debit land with a 20 million, and then they assume the loan, so we credit mortgage with how much? With a 7. All right, with the book value. And then we also know that they also have to deal with share capital. Okay, share capital increases. So we've got a 5 there. Remember, let's just get back to the question. We thought that the land has a fair value of 12 million and an exit carrying value of 12 million. The loan has a book value of 7 million, which we have done, and the issued non-shares have a nominal value of 5 million. So that's what we ran with. But now notice that when you try to check your double entry, we are not balancing. So this simply means we're missing one thing, that is the premium on these shares. So of course, when you say 20 minus 7 minus 5, you should be getting 8, right? You'd have completed that transaction in that way. The needy is selling, so now we don't have a choice but to create some space here. Let me just do that. Insert. Okay, so who is needy? Needy is, of course, the company that is in trouble. Needy sells. Okay, in their books, how do we proceed? So of course we're going to debit investments. Okay, remember that the shares that they're going to buy in the company, that are going to gain in the company, MITI, will be worth not 5 but 8 plus 5, which is a 13, and it's very crucial for you to catch that. So we are saying 8 plus 5, we get that figure there. 5 is the nominal value of the shares and 8 is the share premium. Then we're going to reverse the mortgage, since this will be assumed by the buying company, which is a 7. And then we're going to also reverse the land, credit land at its exit price on carrying value of 12. So I hope that you can see that again we have got a problem with spacing, and it inserts space, a row there. Now notice that when we do, so we supposed to write arrow there. So when you do your maths, you have got a 20 against a 12. The journal is clearly not balancing. So when we introduce the balancing figure here, we find that we have got 8, and that 8 represents profit that was made on the transfer of the land, as well as the assumption or the transfer of the mortgage. So please let us remember that. All right, we progress. Now, it might not be very necessary, of course, to do all these journals in your exams because of time, but I'd like to prepare your mind for what we're going to do in the separate financial statements. We are now going to transaction 3. Transaction 3 says MITI will pay a dividend of 33 million to Desperate to reduce the accumulated reserves of MITI. All right. So we reduce reserves or retained earnings through the payment of a higher dividend. Okay, so let us progress and just work out that. So MITI payment, how does it look? They're paying dividends, so we debit SOCI. All right, if I may write that, dividend paid account with how much? 833, and then we credit bank, of course. Credit bank with 833. All right, progress to the next perspective of this particular dividend. Desperate is receiving the dividend, so what is happening in the books of the receiver? Desperate receipt of the dividend. We debit, of course, bank, all right, with 33, and then we credit profit or loss, of course, dividend received. Dividend received. All right, so that's what you have there. Those are your workings. All right. Next, where do we go from there? Transaction 4. If I may, this is the last transaction. We are told MITI will cut costs by a program of redundancy, laying off workers. According to a detailed plan approved by the board and discussed with labor unions, the redundancies will be spread over 2 years. The cost in the first year is 11 million. The cost in the second year is that much, 24.2 million. The discount rate applicable is 10%. Further, Desperate will incur costs of 1 million to execute the plan. Of course, head office would supervise this redundancy or reorganization exercise. So how do we progress? Remember that we are dealing with what we call future costs, and of course we are caught up with IS 37 that has to deal with provisions. So I'd like to do some quick workings here. There is I can put that one in there. Then there is what we call cash flow. Then there is what we call discount factor, and there's what we call present value. Okay, so again, these are basic. In year 1, in year 2, in the first year 11 million will be spent, and in the second year 24.2 according to the question. I just might increase the so again 10% discount factor. Simple discount is 0.909, and the other side at year 2 0.826. You can always check your tables. Allow me again to increase the decimal places for these. All right, so now we progress as follows. We want to find the PVs for these amounts, future values. There's a 10, and this one I'll keep it like that. There is a 20. Therefore, the total provision arising on these redundancies is a 30. So how do we proceed with the journals? Nice question. So again, you have got millions of dollars, right? Debit profit or loss or income statement. In the books of MITI, of course, this is a journal. How much is involved? 30. Then you credit provisions, and there are two provisions. So credit first provision, which is a current liability to be paid in the first year, a 10, and the second provision, K, which in this case will be a non-current liability, which is a 20. That is how you are supposed to work it out. And then you also remember that parent will incur a cost of reorganizing or supervising this. So we have to consider that. Let me just check that one. The cost, there's a $1. We are told about not a $1, but a 1 million. MITI will cut costs by program redundancy. Further, desperate to incur cost of. All right, so you're able to see that desperate. Let's do some bit of work there. So in the books of desperate, we have to debit costs or the income statement, restructuring costs, $1 million, and then we have to credit liability, again $1 million. All right, so that is it with regards to the journals. Now we need to show how all those things that we've been discussing will affect our financial statements. So I did an advanced work on that, and I'd like to now proceed to showing us how to close off, or how to show how the statements are going to be affected with those journals in mind. And I hope that you will be able to understand. Okay, so from transaction 1, under non-current assets, we know that parent will have increased, will have an investment rather of 160, so that your non-current assets will now be equal to, if I can just sum up, yes, that will be the figure there. So let me sum up as well here throughout. Am I going to just a moment? Okay, just here. I think that'll be fine if I do that. All right, so let us progress. From transaction 1 as well, we see that the 150 investment in Needy is reversed because the shares were sold at 160. All right. We also see that under current assets, money came in, 160 came in and went out. So again, that of course will mean there will be a zero effect. That is new. All right. Now we also see under transaction 3 that a dividend was received, and that is going to increase our assets. All right. So I hope that you can see that those figures there are changing. Okay, so let me just try to sum up, because I can see that by now our figures should have changed. So let's sum up. Okay, so that's what we have, 993 as our total assets for parent after these transactions have been worked out. Okay, let's progress. With regards to our equity and liabilities, retained and share capital has got no change, but retained earnings may have to change. All right. And under working one, we see that we made a profit on the transfer of shares of about 10. All right. And then we also received under transaction 3 a dividend of 33. And then we also incurred as parent a 1 million redundancy costs. All right. And non-current liabilities, there's no change, but under current liabilities there will be a change because our provisions would increase, so our liabilities increase as well. So when I add that, that is what I'm getting. So we've got 100, 442, 200 and 251. When I sum up, let me just try to do that. How much are we having? There we go. So I hope that you can see that our current assets are now equal to our total assets rather are now equal to our total liabilities as well as capital. So for disparate, we done. Let us progress to the next company, which is MITI. We now closing off under non-current assets. We had a 200, but when you consider the note 2, we observe that MITI acquired land 20, so that has to increase our non-current assets. So we push that one there. Okay, for this one, let me not put the totals there. I'll sum up later. Okay, then we also observe that there was an investment, all right, that was made under note 1. There's nothing that is going to affect us under investment in M, but under investment in N, we must be a little bit careful. Why? Because we increased investment, okay, in N and then reduced our cash. So let's just go there to note 1. MITI will purchase the whole of needy share capital for 160 in cash. All right. When Desperate receives the cash, Desperate will then lend the cash to MITI will purchase the whole of needy share capital for 160. So they are losing cash. So meaning that our current assets are reducing, but our investments are increasing. So let's do that. So we increase our investment there, and that should be under note 1, not note 2. So let me write that. But we are losing cash. I hope that you can see that. And then we are told under note 3 that there was a dividend that was paid to our parent company. Okay, those are the only things that affect you there. Let me sum up and see what is going on. So let's go there all the way. So we go to 220 there and we sum up all the way. All right, so let me just counter check that. 220, there's a 160 there. Then we have got 207. Okay, so when I do the summation again, I'm getting 587. Let us progress to the next part of our balance sheet. So under share capital again, we observe there was an issue that is underworking under note 2 that involved the acquisition of shares in Needy at a fair value of 13, 5 plus 8. So I'm going to add that 13 there. And then we are aware also under retained earnings that there was an issue to deal with dividend. Please check your note 3. Our retained earnings will reduce by 3. Then we also know that we have to reduce our retained earnings by 30 because of the provision that we made. Remember the redundancy. All right. And then under non-current liabilities, we're aware under working 2 that we are going to have to assume a loan. So working 2, we're assuming a loan. So I'll push that one down there. Our liabilities are increasing. Okay, and then what else is increasing? Please check your note 3. If we can go there, MITI will pay a dividend of that much. Is that note 3? Okay, not note 3, but note 4 rather. We are told that there were two obligations that were arising, of course, under the provisions. We discounted those. We had the 10 and the 20. So under non-current liabilities, that is note 4. I'll put that one here. We have got a 20 under non-current liabilities, increasing our liabilities, and then we have got a 10 increasing our current liabilities. So again, when you do your summation, you should be able to get the right results. So let me just sum up my figures. All right, I've got a 33 there, and then we have that much. Okay, so 33, 177, 147, 230. Let us have summary of all those amount. Again, we have got that much, which is confirming with that figure there. Okay, that figure and that figure should be the same. Finally, let us deal with MITI revised statement. We are almost there. Okay, so for MITI, what do we see? They lose or reduce in non-current assets. Land had an exit value or carrying value of 12. So we can see that we less from transaction 2. They have an investment. Remember the shares that they sold had fair value of 13. That was 8 plus 5. So we push that one there. They also receive money from parent under note 1 there. So our current assets will increase by 160. All right. I hope that you can see that. So when we sum up, again, those are the only ones that should affect us there. How do we navigate? So let me just do the summation. Alright, so I've got 88 there, and when I do the summation there, I've got those figures. So now let us sum up. We have got a, let me just check that one again. 88 plus a 30 it's supposed to be a minus or a plus. Okay, so let me just, supposed to be a plus a 13, not a minus. That's where the problem is. So we have got a 291. Alright, so we lose value non-current assets of 12. We increase our investments by 13. That is 5 plus 8. And then we also increase our cash by 160. Finally, we deal with equity and liabilities. So for equity and liabilities, we don't have much. Share capital does not have any change. All right, but we have got what we call retained earnings, and I would like us to go to note 2, and then we also have an issue of the non-current liabilities that were reduced by 7. Okay, so let us check if we can work out that one. So note 2, let's check note 2. What is happening in note 2? Note 2 says, okay, remember, MITI will purchase land from needy and pay by assuming a loan from needy, issuing non-voting equity shares. The land has a fair value of 20 million, exit carrying value of 12 million. Now, I remember when we did the journals, we discovered that when MITI sold these assets, they were making a profit of about 8. Check that journal, please, and confirm. So our retained earnings under note 2 will increase by 8, and our non-current liabilities will have reduced by that. So of course the difference there is 1. All right, and then what else do we know? Under note 1, our non-current liabilities will increase because of the loan that we receive from parent. Remember, parent gives us a 160, so that increases our liabilities. So I would like to push that one there. Okay, so now let us sum up and we close. This should be one of the lengthy videos that you've had. Of course, there's a reason for that. Let us sum up and then we close. So we've got a 5, 13, 243, and a 30. So when we do the maths, we are getting that. Okay, that should be equal to that. So thank you very much for your attention, and I hope that you come up with questions.